And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB. ABSA is a registered FSP. 7 minutes after 6 the time. Good evening. I'm Stephen Grootes. Well, as I join you, lots of developments around the B20 and the G20 tonight. We'll speak to some of the people involved in running the B20 in a moment or two. If we can drag Kaz Kuvadia out of what I can just imagine must be the biggest parade of meetings in the history of meetings. He's had the most busy week. He is, of course, the chief Sherpa for the B20. We'll speak to him. We'll speak to Sim Tshabalala as well. But around the G20, President Cyril Ramaphosa, I think, upping the ante a little bit. Earlier today, speaking at the Social 20, that was in Boksburg, he said that countries should not be bullying each other, that all countries are equal. Also said it doesn't matter what your position is in the world or the size of your army. You should not speak down to other countries. I think we all know who he's talking about. Now he's been talking again, and just in the last few moments, and it seems that, in fact, there is still a chance the United States could come to the G20 for the moment. As you know, the US President Donald Trump said that no one would come in quite a strange series of remarks. They went from kind of Cuba to Miami to South Africa in kind of one move. He said no one would come. Now it seems that maybe they will. I wouldn't be surprised just going into the G20 if we kind of have this picture for a little while. And you'll know also that the president had said that just if you're not here, you can't be a part of decisions. And the White House, I think, didn't like that. There's going to be a lot of movement on this particular issue, I think, ahead of the G20 this weekend. All of it is going to put a big focus on us. You may wonder about the economic impact of the G20. City Lodge reporting that their occupancy rate last night was 90.7%. I don't know if City Lodge will ever have had an occupancy rate like that. And their occupancy rate generally has been much higher than it was last year. The same for Southern Sun, by the way. They've also been talking a little bit about that. We spoke to their CEO yesterday. But the B20 and the G20 together already having an economic impact on South Africa. We'll speak about that in just a moment. Before then, the Investec CEO, Kamesh Mudla, on their results and their plans to tackle mid-tier corporate banking. The Reserve Bank interest rate cut, of course, going to have a big impact on you, 25 basis points. And we'll also look at emotions and money habits. All of that to come in the next hour. You know the number, 011 883 0702, 021 446 0567, and voice notes on 072 702 1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, Investec saying today it was able to deliver growth of 2.5% in adjusted earnings per share. It does describe this as a sort of a period of geopolitical uncertainty and market volatility. The bank also launching a new banking unit to target mid-tier firms. I suppose you could call them mid-sized businesses. Their headline earnings per share are up by 3.4% in rand terms, but only by 0.3% in pound terms. The CEO of Investec SA is Kamesh Mudla. Kamesh, good evening. Good to talk to you again. You describe the macroeconomic environment as challenging. Clearly, you're feeling the impact of that.
Thanks, Stephen, and good evening. Obviously, one's looking at 6 months in review in a half year ending in September. So, entering this year, one entered particularly if I look at, for example, the South African market, we forecasted GDP growth of about 2% at the outset of the year. As we stand here in the year to date, you're really looking at GDP growth of 1.1%. So very modest GDP growth, and in what we have described as a overall challenging macroeconomic environment. With that said, we do think the outlook into the second half, or H2 for us, is significantly better, particularly if you take some of the key data points from a South African perspective.
Things are obviously looking a little better, and we'll hope to see if that comes through. You describe the macroeconomic environment as challenging, but there's also tough margin pressure, both here and in the UK. Are you feeling the impact of tougher competition? Is it just about the more competition, and there's a lot more competition in your space?
I think one needs to just take a step back for a moment, Stephen, and in essence, what you for quality deals, quality clients, and I think this is all generally in favor of the consumer, banks are pricing very, very competitively. So you are coming under increasing margin pressure as a result of that. But a key piece for me is to look at what are the data points for us as Investec. And in that context, if we look at our private client franchise in South Africa, we've continued to grow our core clients by just under 10%. Our core lending books across both private client and corporate have continued to grow in the private client space at just over 5%, in the corporate space by just over 7%. So key earnings drivers are still good. Franchise value is being held and is being grown, but you are pricing more competitively given the environment, and also we are in a rate cutting environment at the moment. And if we look at the last period, excluding today, South African interest rates have come down by 100 basis points across in the UK. Similarly, there've been a number of rate cuts. So as a business, as a bank, you have a negative interest rate endowment impact, which you hope is compensated on the other side of your income statement by earnings growth. And given the macros being tighter, we haven't seen that level of growth we would have anticipated.
Mm-hmm. You're now setting up a unit to look at mid-tier firms. There are already banks in the segment that serve that market. Why do you believe you can have an impact there?
So we believe we have a service differentiated model there, Stephen. And I think just maybe, again, if I look at it, just an understanding that in South Africa we already have more than a nascent business in that space. We have 3,000 active clients that we've already banked. Over the next 5 years, we've set a target of getting to 8,000 clients. And what we believe distinguishes us in our service offering is that we're bringing a private banking style of service to the mid-market corporate segment. Personalized, 24/7, 365, with a highly competitive digital and online capability.
I was going to say, I presume quite a few other changes in banking actually allow you to do that a lot more easily just because of the way technology is having such an impact.
Definitely. So we able to build and have been building this for the last 4 years, and we're accelerating that build to complete the rest of what we would need to offer clients from a value proposition perspective. We would complete that within the next 18 months. Historically, if we looked at what we've been spending on this and we've absorbed all of that spend in our existing run rate of costs, Stephen, is that if you'd gone back in time, one would have probably spent billions of rands on building out something now that will cost a fraction of that. And also, in the context of business banking, we don't have legacy as Investec. We're able to do this as a standalone build.
Kumesh Mudla, thanks very much indeed. The CEO at Investec SA, 6:15.
702. Stephen is on X.
At Stephen Grootes.
Well, the B20 summit in Sandton now ending. The presidency of the B20 handed over to the US. It's now their B20 until next year. Meanwhile, the president, Cyril Ramaphosa, using his address at the B20, saying countries should not bully each other, and presumably that's a reference to the United States. Kaz Guvadia is the B20 Sherpa. Kaz, good evening. You must be exhausted. Did you get from the B20 what you wanted? Do you think business leaders were able to have the conversations they needed to have?
Yeah, so this was a summit. I mean, the conversation essentially happened from March to about September when we handed over recommendations to the G20. So the summit was essentially an opportunity to have some global leaders together, talk about some of the global issues, the African issues, and so on. Our expectation was to have a good number of international people, and we got about 48% of the 2,000 odd people who were there were from outside the country. We had very good content. We had very good panels and discussions. I think we succeeded in putting Africa at the center of the agenda and promoting the continent in a positive way, while also being pragmatic about the challenges we have. I think we've achieved what we set out to achieve. I think our recommendations are practical and implementable, and we hope that we will be able to track them and measure impact of implementation. And we handed over to the US just after the president's speech this afternoon.
The Trump administration, for the moment, is a bit in flux as I talk to you. 10 minutes ago, 20 minutes ago, it looked like they weren't coming. Now, President Ramaphosa suggests they might. But the U.S. Chamber of Commerce has been there in a big way this week. What do you think that tells us?
Well, not only this week, the U.S. Chamber of Commerce, as well as a sizable number of C-suite business people from the U.S., have been involved in the task forces since March and have participated in the debate and the discussion and have been part of the sign-off of the recommendation. So U.S. business has been very supportive, very involved. When the president of the U.S. Chamber of Commerce spoke today after receiving the handover, she committed U.S. business to collaboration, to working with others to actually grow inclusive economies. She actually said that this trip here has opened their eyes to the opportunities on the continent, and the U.S. business would be very interested in getting involved in investing in the continent. So they've been involved throughout this year, and even when President Trump 2 weeks ago, I think it was on a Friday, made the announcement that they are not coming and nobody is coming, I thought I'd leave it for Monday to speak to our colleagues in the U.S. business fraternity, whether that impacted on their views. And I didn't even have to wait until Monday. I mean, over the weekend, I got messages from everybody who's faking to say, Cass, don't worry, everything on track. We'll be there. This doesn't change anything. So they've been very supportive.
Do you believe the B20 will be able to set a tone in some way for the G20? I mean, obviously business doesn't make up the whole of the G20, and one is heavily political and one is sort of heavily business. On the other hand, business often in many places does have an influence on politics in important ways and often productive ways.
Yeah. Look, I as you said in your opening, the U.S. government's position seems to be in flux at the moment, and that's exactly the problem. I mean, it's very difficult to actually plan and to develop some sort of strategy on how B20 will try to relate to the G20 in the U.S. And I don't envy them, to be quite honest. But I think that we certainly, between the Sherpa in Brazil, myself, the Sherpa in the U.S., and I've spoken to the British Chamber of Industries, because I believe they'll be taking over in 2027. I'm trying to encourage that at least to begin with, the four of us establish some sort of mechanism, even if it's a virtual mechanism, to just help each other, and particularly to help the U.S. to try and position things properly, to see if they can interact more constructively with their government. But a lot will depend on the U.S. government's approach toward the G20 next year, whether they continue with the sort of issues that have been discussed this year, or whether they just can some of those issues like climate change and so on. So I think a lot will depend on the U.S. administration's approach to the G20 next year. But we will work with the U.S. Chamber of Commerce to see whether we can maintain the efficacy of the B20 through those turbulent sort of times in the U.S. Because when the G20 is not on, at idem, or at least has had positive discussions with the B20, it's extremely difficult for the B20 to actually do what it needs to do.
Kaz Kavadia, really appreciate the time. Thank you. The B20 Sherpa. Hope you get some sleep at some point in the next couple of days. 21 minutes after 6. Someone who's been leading some of the conversations at the B20, and I'm sure he'll be watching the G20 very closely, is Sim Tshabalala. You know him in his day job as Standard Bank CEO, but his job this week has been as co-chair of the B20 Finance and Infrastructure Task Force. Sim, good evening. Thank you for your time tonight. You've been talking in these meetings. You've been talking in public about the need for capital to finance infrastructure. Do you believe you were able to move the dial? Do you believe the conversations this week moved the dial, particularly with regard to investing in infrastructure for Africa?
Stephen, and good evening to your listeners. just a couple of data points. The first one is that everything we've spoken about this week is mirrored in the expert panel for the G20, headed by Trevor Manuel. And they've got a couple of paragraphs in their report that dovetail with ours in relation to, firstly, the role of ratings agencies and how they ought to be conducting themselves and the need for transparency, as well as our recommendations in respect of the reduction of capital to be held against infrastructure projects so that we as banks and insurance companies can lend more. This has also been mirrored in speeches made by the central bank governor, Lesetja Kganyago, and I've also heard other central bank governors, including the central bank governor of Egypt, mirroring these comments. So the recommendations which Kaz made reference to, which were in that communique that was handed over to the American Chamber of Commerce, are things that are just going to be continued into the future. So that's a concrete thing. And your reference to my day job, managing the cost of capital is central to what a banker does, Stephen.
The real issue, I suppose, is whether any of this, all of the meetings, all of the conversations that you've been involved in for so many months, whether it will, for us, result in a change in our priority, which I think is probably whether people will invest money in Africa. And the need for infrastructure is huge, but the market is also growing, which means that while I suppose someone sitting in Germany might think there's still risk in Africa, the opportunity is surely growing for them all the time.
The opportunity, Stephen, is vast. And the gap, as you and I have spoken about in the past, is $100 billion a year. We can only raise about 65 of that off African resources. And there's this 45 billion that needs to be raised from other sources. There is vast amounts of resources on the African continent that get invested outside Africa and then get reinvested back when African sovereigns raise that money. It's actually perverse. And we need to be stimulating the investment by pension funds, asset managers, banks on the continent so that we can attract other people to the continent.
I mean, I don't know if you've given any thought to what you'd like to see from the G20. A lot of people might be hoping what seems to have been a very successful B20 will kind of set a tone in some way. I mean, there's no direct linkage, but you would like to think that they would. Do you have any thoughts about what you would like to see from the G20 this weekend?
Okay. The G20 will be what it will be. We're quite satisfied that as the B20, the issues that we've tabled and have included in our communique will find themselves in the communique that will be issued by the G20. If that was not to happen, I would still submit to you that the conversations, the policy conversations we've been having amongst ourselves and with policymakers and standard setters and central banks will continue regardless of what happens in the G20. And so what I'm saying to you is that the formality of gatherings at the G20 and at the B20 is not crucial. What is crucial are the conversations that people are having that nudge policy in the direction of financing infrastructure.
Sim Tshabalala, good to talk to you. Thank you very much. Really do appreciate the time. The CEO at Standard Bank, but speaking to us tonight as co-chair of the B20 Finance and Infrastructure Task Force.
The Money Show.
The Markers.
Graham Kerners at the Kerner Perspective. Graham, good evening. An interest rate cut today. Obviously, that would help the banks today, and even though it was widely expected.
Yeah, good evening, Stephen. I think myself, when we heard we were moving to that 3% inflation target, I got a little bit anxious, and you saw the print coming out sort of going the wrong way. But I think the governor spoke well about the fact that those are probably transient pressures. So, yeah, it was good to see that it was a unanimous decision. And let's say it's a Black Friday and maybe an early Christmas present for all the shoppers in South Africa. And if you look at, what the likes of TFG and Mr. Price have been saying consumers really need a little bit of a break.
No, absolutely. Investors did not really like Investec's update today. I mean, quite nice, ambitious plans, take on mid-tier corporate banking and things like that. But investors were not happy with what they saw.
Yeah, I suppose, Stephen, the problem is that when you look at it, sub 9 PE dividend yield, I think, is over 6%. But they're no different to the other banks. And arguably the other banks have got probably, more visible runway to, let's say, late teens, early double digits earnings growth. So I think, it's a better business, I would say, than it has been for a while, but I think it's operating in quite a cluttered space. So, it's crazy to see a company, that's so cheap paying that kind of dividend yield underperform. But you've seen in contrast, somebody like Absa go from 190 to, let's say, 210. In a very short space of time. And I think it's really just the valuation differential. So I think, the update and maybe the guidance a little bit disappointing. Good plans, and there's obviously, strategic intent to pivot the business further. But I think the market's sort of just right now focusing on the near-term earnings outlook. And respectfully, I think the other banks probably have more visible and higher earnings growth outlooks for the next year or so than Investec.
Mr. Price putting out quite a bullish update today. They say they've outperformed their competitors effectively in quite a tough and very competitive market.
Yeah, very much so. I mean, in stark contrast, it was up, I think, over 6%, whereas Investec, if memory serves, was down about 5%. So neither of them were sort of earth-shattering results, but I think, to produce slightly above inflation revenue growth and profit growth, the market clearly rewarded Mr. Price for that. But I think to your point, Stephen, it's a very, very difficult environment. You saw it from TFG, although there's probably some technical stuff there, but, the market clearly still likes the business model, in terms of value, and backs the management. I think their point was that, rate cuts and the likes have not been enough to offset what has really been, negative real wage growth for some time now.
And then in the US, they seem to be having a rip-roaring day, really sparked, I suppose, by NVIDIA's results last night, better than expected.
The market was really on tenterhooks going into these NVIDIA results. I think there's been a growing anxiety around AI, and then NVIDIA comes out, if you look at third quarter, compared to the comparable quarter, up over 60%. Now, when the biggest company in the world, I think is 8% of the S&P 500, shoots the lights out by that quantum. They're talking about, the Blackwell and Rubin chips, I think, selling over $500 billion. That's all $500 billion worth of sales in FY26. I mean, these numbers are just incredible. So it's difficult for old timers like me who sort of watch the AI boom with a degree of skepticism because, the poster child for this is coming out with spectacular results. The order book looks good. And they're saying, their cloud GPUs are basically sold out. So really got the wind at their backs. And that, I think, eased the fears that the market had coming into this week.
Graham Kerner, thanks very much indeed. He's at the Kerner Perspective.
WhatsApp Stephen
on 072
702
1702.
22 minutes to 7. Well, yes, obviously lots of conversations about the B20, the G20. Somewhere in there was the social 20, which also ended today. Voice notes coming through this evening.
Hi, Stephen. Interesting conversation you're having. Is it possible for you to explain to us what a Sherpa is? I've just been curious ever since hearing that term ascribed to certain members of the B20, certain officials of the B20. I always thought it was the guys going up Mount Everest, leading the pack. Is that the similarities? Do the B20 have a mountain to climb? They lead the Sherpas? Is that what it means? Please explain. Thank you. Mark.
You're bang on. Yeah, that is my understanding, actually. They are the people who help you or guide you up a mountain. A long tradition of Sherpas in India, Nepal, that part of the world. I'm no expert on it. Probably burst into the European imagination with Sherpa Tenzing and Edmund Hillary's climb up Mount Everest, the first people to do that. Oh, in the 1950s now, I can't remember. But what they mean in this context, my understanding of it, having spoken to a couple, Kaz Gavadia is one, is that they are the people who do kind of manage the process. So it's not like a director who can direct events. It's a bit more, I suppose, political than that. There is also a Sherpa for the G20, by the way, who, if I remember correctly, is the Director General of International Relations, Zane Dangor. So maybe another word would be shepherd, if you see what I mean. You can't sort of force, because I imagine hosting, managing the G20 is literally like herding cats. But it is the person who tries to sort of do that. Maybe, herding a cat with a pool noodle or something. Your thoughts, if you know more on it than I do. Maybe you went to Sir Edmund Hillary's school in Joburg and you know more about a Sherpa. I'd really appreciate it. 19 minutes to 7.
The Money Show.
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
Just gone 7:15 the time. The Reserve Bank's Monetary Policy Committee, I suppose, meeting expectations today. Cut interest rates by 25 basis points, despite the fact that they have a brand new, slightly lower inflation target of just 3%, as announced by the Finance Minister, Enoch Godongwana, last week. Isaah Mhlanga is Chief Economist at Rand Merchant Bank. Isaah, good evening. A unanimous decision, the committee saying they believe inflation is contained. Do you agree with that for the moment?
Indeed, we agree, Stephen. We had a conditional cut on the condition that National Treasury adopts a 3% inflation target, which is exactly what happened last week. And then, currency strengthened, oil prices are lower than what the Reserve Bank forecasted at the previous MPC. And if you look in terms of risk premiums, they've also declined, which is, visible in bond markets. So all of those factors combined, we think there were reason enough for the MPC to say it's appropriate to cut rates by 25 basis points. But even when you look at core inflation, it's still closer to 3%, despite the fact that headline inflation, increased to 3.6% for the last month. What is more important for the SARB is the forward-looking inflation, not necessarily the actual recent inflation print. And that forward-looking inflation says they are going to hit 3% inflation over the medium term.
I mean, there are one or two concerns. Food, maybe meat, still an issue. The MPC may be also a little bit worried about the rand. I mean, yes, the rand's been stronger, the dollar's been weaker. They're not necessarily convinced that it'll be like that for the longer term.
Indeed, for food, it has been, slightly higher, pushing, headline inflation higher. It tends to be quite volatile. But their statement, they say they are going to look through that short-term volatility. We have good rains, which means harvest is going to be likely better, and therefore food price inflation is likely to moderate going forward. And your point on the currency, it's always subject to global risk factors, the bigger one being the dollar. So far, it has been supportive. The dollar has been weakening, which means the rand has been strong, in addition to being supported by commodity prices. But if we see the dollar turns, that can turn the trajectory of the rand weaker, and that will be inflationary. But there is also another risk which the SARB considered, which is electricity prices coming from the 54 billion rand pricing error out of NESA as far as Eskom is concerned. If that materializes, it might push to an extent electricity prices and exert upward pressure on inflation. Those are risks. It's not the baseline. On the basis of the baseline, inflation is still well contained, closer to 3% if you look at, or even headline if you look the forecast over the medium term.
I mean, it really tells you the impact electricity prices have and can still have, how they can shock inflation. But they're not the only problem with administered prices. I mean, we're some way away from knowing what councils will do next year, but I'll be frankly amazed if councils kept their increases to what is now inflation. Administered inflation, isn't that really going to be the big problem with sticking to 3%?
Look, I think that's going to be the big test of whether we see inflation converging closer to 3% quicker or not. But eventually, over time, the Reserve Bank will respond if inflation expectations do not converge to the lower inflation target. So over the short term, that is the big question. Will Labour accept salaries and wages that are closer to 3%? Will the municipalities increase water and electricity tariffs closer to 3%? That still remains the big question.
Isaah Mhlanga, really appreciate the time tonight. Thank you. Chief Economist at Rand Merchant Bank. 11 minutes now to 7 the time.
The Money Show with Stephen Grootes is brought to you by Absa CIB. Absa is a registered FSP.
7:02. Stephen is on The Money Show.
6 to 8 p.m.
The Money Show is in conversation with Momentum, discussing the importance of focus in the science of success. And we often assume that financial success comes from luck, from timing, big earnings. Momentum's Science of Success campaign actually suggests it's, well, science, rooted in behavior. Tonight we explore the money fingerprint, Momentum's behavioral tool. It reveals how emotions, experiences, just your general personality shapes the way you handle money. Paul Nixon is Momentum's head of behavioral finance. He's with me in our Joburg studios. Janez Vermeuren is a TV host and entrepreneur who's taken the money fingerprint test himself. He's in our Cape Town studios. One of us is having a better time than the other. We won't say who. Janez, good evening. Thanks for joining us. Before we get into the results of your money fingerprint, I mean, you've been involved in building businesses. You've made some risks. You've navigated different industries. When you think about money, when you think about making decisions, what do you think sort of has shaped your financial philosophy the most?
That's a good question. I was raised by very creative parents that weren't really money focused, and also they raised me not to, I guess, not to be a materialist. So they always taught me that experiences is where the real value lies, and that's something I've kind of carried forward in my life, and I think it's what's made me such not a risk taker, but I'm not scared to make a move, if you know what I mean. You know, I've always, when I've got an idea and I believe in it, then I do it without worrying too much about it. And I think most people actually, they often speak about doing something and then they never end up doing it just because of fear, and I've learned how to, I guess, fail forward.
Yes. No. I know exactly what you mean. You took the Momentum money fingerprint test.
Yeah.
Was there anything that surprised you? I mean, you deal with money, so you must have an understanding of kind of your own view of it. How did you find the result?
Yeah, what was interesting to me is, and I think it's a test that most people would benefit from, because, when I did the test, I kind of knew how, my relationship with money, but also it clearly stated that, I wasn't scared of taking risks and making moves in business. But at the same time, I also had a real fear of kind of, I guess, running out of money or not being able to support my family. And that in the back of my head, whenever I do something, I guess the older you get, the less you're inclined to take risks. And I guess at the end of the day, what I learned from the test is, yes, I am a risk taker, but I'm also conservative, and it's more calculated risks than just wild risks.
Paul Nixon, I mean, what Janez, I suppose, is describing is around, your fears, your personality, how they actually influence the financial choices you make.
Exactly, Stephen. Yeah. So, I think if you can think of the very famous marshmallow experiments, that they did in Stanford in the 1970s, you have this, you could see the kids at that stage even had almost like a factory setting that some of them were just kind of better at the future than the others. So some of them would cover the marshmallow, look at stare in the corner of the room.
So they would get 2 marshmallows if they didn't eat it immediately. Yeah.
And they got the second one if they just waited, right? And whereas some, before the instructions were even sort of made clear to them, the marshmallow was already in the mouth. So, that's your factory settings. But then, you might have a child, for example, who had those factory settings, but then they had 5 siblings. So they realized that if they didn't eat the marshmallow immediately, they didn't get one. So that kind of gives you the interplay of your factory settings, your personality, but then also how your experience sort of, adds and makes that a little bit more dynamic. And then, of course, in the moment, you have these emotional decisions that you can make through, through market ups and downs. So these 3 things have a definite interplay in terms of understanding where your money behavior is coming from. And that obviously is very valuable for your financial advisor.
I mean, Jeanez, you have been involved in risk. You start companies. I mean, that means risk. Did you see that in your test results? I mean, the way in which you grew up, you said your parents were creative. And doesn't that by definition mean that they took risks too?
They did take risks. and yeah, I guess I'm a natural born entrepreneur. I've never really worked for anyone. And it definitely showed in my tests. I am definitely a risk taker. And I think the thing with me is that, I've failed so many times, and people don't often speak about that. They only see the successes, and they speak about the successes, but it's actually the failures that you learn from the most. And it's those failures, like I said, you have to learn how to fail forward. And if you fail enough times, you'll eventually be successful. You've got to kind of stick to your guns, and that's something that money, I wouldn't say it's come easily to me, but I've always backed myself that if I do fail, I'll be able to reinvent myself and do it again, and it's all about taking risk, and often it's, it's calculated, but you don't always know what every step of the way is going to be. Life throws curveballs at you all the time, but you've just got to kind of forge along and keep pushing.
Paul, one of the whole point really of the money fingerprint is to reveal the kind of emotional pattern you don't know. I mean, we can all look in a mirror and say, I could have been, the centre forward for Kaizer Chiefs, and we can all be wrong. From the assessments you've looked at, do you see kind of surprising or behaviour that strikes you as counterintuitive, or people might think, well, this is good about the way I manage money, but is actually really holding them back?
Yeah, I think probably the biggest one there is this money attitude of hypervigilance. So, it seems like a good thing, right? And our parents and we've probably heard a lot about, if you get money, save it. But that can, there's obviously a very an important part of that dimension, which is obviously you'll have more, but you need to also learn to enjoy the journey as well. So, I think that the world has changed over the last 10 years, where people are, if you look at Morgan Housel's book, The Psychology of Money, he talks about that gas station attendant who managed to save or accumulate about $8 million. And he lived in a tiny apartment and, didn't have a car, and he left most of his wealth to charity at the end of it. So you can sort of, it's a good example of, this hypervigilance with money, accumulating a massive wealth, but not really experiencing, the benefit of that behavior. So that's probably the biggest one in terms of, being prudent, vigilant with money is good and important, but, you have to find that balance as well in creating experiences and memories with your loved ones. Yeah.
You have to have a bit of marshmallow. Jeanez, after the money fingerprint, looking at your experience, what's the one insight you think other entrepreneurs or young investors should get from it?
Well, a financial advisor is probably the most important thing you need as a young person that's kind of working his way up the ladder and through life. It's something I wish I had when I was younger. And, I've had various financial advisors, and I always felt like we didn't quite gel. And I think, through this test, the financial advisor can actually understand your personality and what your appetite is for certain investments, and that's so important. Had I had this in my early 20s, even though I did put some money away into property and stuff like that, but I think my investments would have been far greater than what they are today if I had just been kind of guided along properly and wisely, and I guess in a way that follows my appetite or my relationship with money.
Paul, if someone wants to do their own money fingerprint or they want to join, where would they go?
Just go to moneyfingerprint.co.za and give it a crack.
Paul Nixon, thank you. Momentum's head of behavioral finance. Janez Vermeeren is a TV host and entrepreneur.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB. Absa is a registered FSP. 7 minutes after 7. Lots to come. We'll speak to Siphumelele Zondi, the tech expert, in just a moment. AI influencers are taking the lunch of human influencers. I know, I didn't feel any sympathy either, I have to say. I've never really understood the influencer phenomenon. Maybe I'm just a boomer or perilously close to being one. But the idea basically of just having a good time and building and not having any responsibility, which is what influencing looked like to me, and not really caring what you were actually selling, did make it sort of hard to care. I mean, there'll be people who have an income and that would be difficult. But so if AI influencers take over, the other question, of course, is, do they work? I mean, would you buy something from someone that's trying to be a person, but in fact is not one? I suppose you could argue we kind of do it all the time. We will speak to David Morobe in about 10 minutes from Business Partners in Small Business Focus, looking at confidence in the national coalition, looking at what small businesses want from government. It's been one of the more interesting conversations. And then really looking forward to Investment School tonight, how tech and computing power are transforming investment strategies, and more sort of computers, bits of code, algorithms, rather than actual human beings are making investment decisions. And I think that's really very interesting.
702.
702.
Stephen is on The Money Show.
6 to 8 p.m.
So just thinking a little bit about what's going to happen around the G20, and it does seem to me this is a moment, depending on how things go, when President Ramaphosa, and he may well be the right person to do it, is able to put quite a lot of heat on the Trump administration. Just thinking of the reporting, what we've seen, Ramaphosa's comments that, the White House does suddenly want to come. The White House may well go ahead and, I suppose, deny it or confirm it. Either way, it does put a bit of pressure back on Trump. And maybe that's kind of the plan. Maybe there's a bit of a thought here. Maybe someone actually is thinking about the game of pressure, and that's often what these things need. If anyone understands how politics is a game of pressure, let me tell you this, it's Ramaphosa. He really does. And if he can be seen to be the one to put Trump under pressure, well, that might change the game. Your thoughts, 011 883 0702 021 446 0567, and voice notes on 072 702 1702.
The Money Show, Tech Thursday.
12 minutes after 7. Well, among the many evils that social media inflicted upon us were influencers. And influencers really started to change the game. It seemed that they were cheaper than big campaigns. They already had quite a big reach. They could influence people, and many of them didn't seem to care what on earth they were selling. I mean, remember the nonsense around that energy drink a few years ago. Now it seems that we've entered the world of, wait for it, an AI influencer. Siphumelele Zondi is our tech expert. Siphumelele, good evening. As I think you can probably tell, I don't have a lot of time for influencers. What, dare I say, fresh hell is an AI influencer?
Well, hello, Stephen. It's actually influencers that look human. If you just sort of like look through and then not pay careful attention, you think you are looking at humans, but it's actually AI-generated images of people convincing other people about their life stories and what it is that they should be doing with their lives. So it seems to be a growing trend internationally to have these AI-generated visuals of images of that have been created by people on their devices that look like humans, but that actually aren't real humans.
And what on earth are they discussing? The life and the meaning of, life and the meaning of it?
Think about, for example, there's one called Granny Spills. So it's a grandmother, like a 65-year-old plus, could be 70-something-year-old, who's giving life advice, who's giving love advice, telling people what to do, what not to do, and would say things like flowers are temporary, but an expensive bag is forever. So that's what you should be focusing on as a young woman. And think about the talking baby babies as well. There was one earlier who was actually attending the one of the tennis tournaments. I think it was Wimbledon, who would appear on center court. And if you weren't paying careful attention, you'd be like, oh, how the hell did she manage that? How the hell did she manage to end up in center court? But she does things that normal humans can't actually do. And some of them would be your style influencers, and they're telling you what to wear, what not to wear, and what you should actually look like, and advice about your image.
I get enough advice about my image, thanks. Is it changing the way things are actually done?
Yes, it already is starting on a small scale, and it definitely will probably go bigger, because you do hear some of these AI influencer generators saying that they're starting to make sometimes a couple of hundreds of thousands of US dollars. Some say even as much as $1 million US dollars from campaigns. So these influencers are getting real campaigns that used to go to real humans in the past.
I mean, the scary thing about this is that there'll be no accountability. So you could have an influencer that tells people to do really bad things, targets teenagers online in really poor ways. I mean, really negative things. And you wouldn't actually know who's behind it, would you?
At this present moment, a lot of the people that have created them are anonymous, but I suppose you could always trace who the creator of a particular influencer actually is, and which bedroom they were sitting in when they created the image. But yes, there is that danger that you're now not looking at a person with an ID number who is easily identifiable. You are now looking at images that might take a long time to figure out on where they actually came from. So yes, there is that danger. But also when it comes to beauty, danger is about image as well, because these are AI generated people, if you will. So they might not actually have attainable body types, because you can make them look however it is that you want them to look.
Thank you. Do they work? Do people trust them? And people, I think, generally are sold something by a human. So that must be one thing. But do these have the same impact on people? I suppose what I'm really asking is, does fakery have the same impact on us as a real person on social media?
Oh, it could, because the fact that some of these AI influencers have hundreds of thousands of followers already, that means that it could get to a point where they are trying to, where they are successful in convincing some of their followers to go a certain direction with whichever campaign. When you think even about real human influencers, can you really trust them? Because I remember seeing something the other day about a South African influencer, actually, when someone asked a question as she was selling a face wash product, and they're like, oh, so now we are moving from that other face wash product. We've now moved to another face wash product. So which is it? Which should we be trusting? Because they seem to be accepting whoever is paying money. And so can you really trust real influencers? So they could possibly manage to convince some of their hundreds of thousands of followers.
Siphumelele Zondi, thanks very much indeed. Really appreciate it. Our tech expert on The Money Show. 18 minutes after 7.
The Money Show. Small business focus.
There's been so many stories in the last few days about the recovery, the green shoots, the right direction, everything that you've heard from the finance minister. In a way, confirmed, I suppose, the latest wave of good news by the interest rate cut that we saw today. David Marobe is the Regional General Manager at Business Partners. David, good evening. I really appreciate you coming in. Thank you very much indeed. I mean, I'm going to put this in inverted commas for now. This economic recovery, okay, that we're seeing, it looks very good. Is it helping small and medium enterprises? Are they feeling anything?
Indeed it is. The macroeconomic variables impact on small and medium enterprises, and it influences how they operate. Think about it. They are still the cornerstone of economic activity. They are the ones that address issues such as unemployment. So when you address variables such as inflation, they are able to contain their costs. When you contain that inflation, they're able to plan better, to expand their businesses better, because they're dealing with more controlled environment. And what happened today with the reduction of the interest rate lowers their borrowing costs. It provides price stability for them, and they can plan better and hopefully expand their business and employ more people.
I mean, there are other concerns. There's a lot of, it's a strange phrase. There's a lot of geopolitics around, but I'm talking particularly around things like tariffs. It suddenly makes the entire operating environment very difficult to predict.
Well, mostly those SMEs that are reliant on imports or those that are export orientated have complained to us because we run a confidence index quarterly that gets them to say what is it that affects them. So most of them said it affects them directly, and some of them, I would say about 40% was more indirect being affected because that environment, the protectionism that comes from larger economies might sort of hamper their export potential or get the greater costs of things for those that they import into the country. So it is something that we need to contain, and especially for SMEs, because they would like to have lower input costs so that they can maximize what they get out of their businesses.
Do you think small business has a reason to feel confidence in the national coalition? I mean, the way the government is, things are changing. I hear the phrase, I've used it myself actually, Cyril's economy, and it's used in quite a kind of loaded and a sort of negative way. And I don't think people necessarily blame him for everything. I think it's like saying Biden's economy, or Trump's economy. It's kind of an expression of frustration at where we are.
Yeah, indeed. A lot of people have been frustrated, but perhaps the cliche that goes that entrepreneurs are eternal optimists rings true in this case, because they're still confident that their businesses will do well, in the next 12 months that their businesses will grow. But they had serious concerns in the second quarter of the year after the budget the budget process lacked a bit of clarity in terms of its approval. There was contestations amongst the various parties, if you remember. And then many of them had actually set up systems to adjust the VAT, because that was like something that was going to happen.
That was crazy, by the way. There was never any accountability for that.
Indeed. And then they had to reverse all that they had put in place for them to. So that was creating a lot of consternation amongst them. But notwithstanding that, we're still seeing high optimism amongst SMEs. And I think that's why it's so good to work with entrepreneurs.
I mean, I've done it too often, and I'm just not going to do it again. Like, I hear nothing from the Small Business Development Ministry on that. But, anyway. What do you think government should be doing to help small and medium enterprises right now? I mean, yes, there are parties from different ideologies in the government, but they all say that they want more young people to be in work, and that means entrepreneurship is obviously the way to go.
It's a good start. There's agreement around small businesses. It's something that can absorb young people. I've seen them now engage better. Before the medium-term budget speech, they actually engaged with the president. The parties seem to agree on what is important. Put South Africa first, if you might call it that. And that seems to have yielded results, because at the budget speech, they were able to come up with some more policy certainty, which is what small and medium enterprises want to see. They'd like to see government give more support in terms of that stability that I've mentioned, policy consistency, and they need to work with the private sector, because government alone cannot do it. Issues like unemployment need government to create an environment where SMEs can be able to thrive, and that way you've got a more promising environment where they can do that which needs to be done. Entrepreneurs are about opening doors. When they have that opportunity, they can do it. What we also want to see is that we need to have blended funds going forward. Those that are seeking commercial returns, philanthropic funds can really add value, because they can help to lower the cost of capital for those SMEs, and government can come in with some of lending that behaves more in the nature of equity for those SMEs.
I mean, I think the other thing is just confidence. If you can, just keep it all together, guys, that gives entrepreneurs a lot more confidence. How important is confidence for people running small businesses right now?
I think it's the center of it all. It's a trait that marks entrepreneurs. I was actually listening to you earlier on about an entrepreneur that is more prone. He likes to take risk, even though cautious. That's what we see with entrepreneurs. They believe in what they are doing. They believe they can add value. They believe they can bring more products and services. If you see some of the products that have come out of the country, they will surprise you that there's a Yoko Capital that has come up, and many other products that It's not only the big economies that have a monopoly of good products and services. Even our entrepreneurs can really produce so, and we've proven it many times over.
Thanks so much. Really appreciate that. David Morobe is the Regional General Manager at Business Partners on Small Business Focus on The Money Show tonight.
The Money Show, Stephen Grootes, is brought to you by ABSA CIB. ABSA is a registered FSP.
Show.
Investment School.
24 minutes now to 8 the time. So one of the more interesting things around investing is how technology affects investing, by which I don't mean should you invest in these technology stocks. I mean how the way in which decisions are made is impacted by the technology that you are using. To put it another way, we would speak English to each other in a certain way when people were writing letters. When email came, the way in which we spoke to each other changed, and we used different words and different terminology. When WhatsApp came, it changed again. Does that make sense? I think it makes sense to me. I'm hoping so. So now you can invest in different ways because they're newer technologies, and that will change the way in which decisions are made, which can change the decision. To discuss this tonight, Stefan Engelbrecht is a portfolio manager for Mazi Next Gen at Maxi Asset, and Viv Govender is a portfolio manager at Ransford. James, thanks so much for coming in. I really appreciate it. All right, Stefan, I'm going to start with you on this. I think most of us, certainly me most of the time, has this idea of hundreds, thousands of people sitting in rooms somewhere with access to computers making investment decisions. But in fact, it's not like that. In many cases, the computers are making the decisions. I realize it's a big question. How does that work?
Well, Stephen, that is a very big question. But firstly, thank you very much for having me on tonight. Yeah, I'm very happy that you're having the show tonight, because I always find it very interesting how investment managers stand on podiums or on radio talk shows, and they talk about how the in technology and AI is going to change every single industry in the world. But they never talk about their own industry. They somehow think they're special and that the investment management industry is not going to be impacted, when in fact it is really being impacted. So basically how machine learning is impacting the investment world is just, we're getting so much information at the moment.
Yeah.
I mean, there's a barrage of new information coming all the time. And human beings, even the most intelligent human beings, we struggle to keep 6, 7 variables in our head at one time to make an accurate decision. Computers have no limit. Maths is maths. Whether you're in 3 dimensions, 4 dimensions, 27, 37, 1,000 dimension, you can just keep on giving new variables and new information, and will each time reallocate and without emotion make a new decision and give you output. Now, some firms will use this information that the computer will distill and use the human to then have a sense check or use it as an input for the human to then go and decide. Where others more and more realize that decision making of human beings can be quite emotional and inaccurate, and they start to put the human now there to support the machine and to make more accurate decisions.
So would an analogy be someone uses ChatGPT to do their homework? You read the homework before you hand it in just to check that it's okay and not too obvious. But now, actually, ChatGPT is doing your homework better than you ever could, so it's best that you don't read it.
It's probably not a good analogy, given that I don't want to tell my kids that they will use ChatGPT to do their homework. But yes, that is exactly exactly right. But quite often, see, the key part where the human being is still critical is that we still have to identify the question. We still have to ask the right problem statement and identify the problem statement and give the machine the correct variables and input variables to use to solve for the problem statement that we have identified. So we are still definitely the creators behind the investment strategies. The machines are just there to actually then go and solve for that investment objective.
At least on this Thursday night. Viv Govender, so there's another aspect to this, which is where computers are better than humans, is speed. And there's been, and I know virtually nothing about it, but a sort of high speed, high frequency trading, which humans can't actually do. How does that work?
Well, that's literally about speed. So if you look at there's multiple markets in which an instrument might trade, then they are often geographically separate. And if you can somehow get your signal that the buy is happening in one market to another market quickly enough, you could actually front run an order. And that is why you've seen, for instance, historically, people used to have these radio towers, and because it's line of sight. And instead of going through some kind of weird cable around the world, you go straight line of sight, radio tower, and you're quicker across the distance. And there was even an argument made that somebody floated the idea of literally floating balloons across the Atlantic Ocean to speed up the speed of transactions between the two. But that is basically not intelligence. It's just physics. It's just about speed. You see a guy in London wants to buy something, that it also trades in New York. You basically get your signal to New York that somebody wants to buy a huge amount of the stuff. You buy it first. When his signal arrives in New York, you own the stuff. You can sell it to him for a cent or two more. And that is like the high frequency trading, like front running thing that they do. It really doesn't add much to the world. In fact, it's actually a tax on the normal investor out there, because all it does is it makes any investment decision get taxed a couple cents by the guy that actually does it faster. And there's huge amounts of money being spent, effectively not making the world a better place. The thing with
isn't that investing?
but investing, I think proper investing, like what a active manager does, is important. I mean, there's a reason that Holland was a world power. They got the first stock market. The proper allocation of capital is something the investment managers do, and if computers can aid in that and make it more logical and make it more better, basically optimized, it actually will have downstream effects, because it would mean that the allocation of capital is better. It would mean that you would have a clearer idea, or businesses that deserve the money would get it more quickly and more easily. And I think that's important in the longer term. Obviously not in the secondary market like we talk about, but in the primary markets and so on. And then obviously the secondary market does feed into the primary market down the line and so on.
Stefan, there's another way of looking at all of this, which is around systemic funds or systematic funds. I think most of us can, we understand discretionary funds. That's where someone gives Stephen money and tells him to invest it and he makes decisions. There are passive funds where I just put everything in the JSE and see what it does. What is a systematic fund compared to the other two?
So a systematic fund is basically where you systematize your decision making. So this is where the human being, so we ask Stephen, how do you select stocks? And you say it has to have a PE below 5, it has to have a dividend yield above whatever, and you create your rules. But then what has been proven over and over again is that once you've created those rules, an algorithm or a machine is actually better at implementing those rules than you are. Because, for example, let's say that you say you will only buy Capitec if it's trading on a PE of 15 or something like that. Capitec won't just drop to a PE of 15 in a vacuum and just suddenly will be the same environment just trading on a PE of 50. There will be something that's happening. There will be a crisis. There will be a Viceroy report or something like that happening. And suddenly you will follow the narrative that is in the market and you will convince yourself not to follow your own rule. And what's been proven over and over, not just in finance, it's been proven in medical studies as well as parole officers. Those narrative-driven decisions causes the human being to underperform their own rules that they've set up beforehand.
Okay, so basically it's a way of making our brain always rule our heart. It's a way of shutting our heart up, actually.
Yeah, your own logic. Your brain is just as guilty. It's your unemotional brain, the brain that creates the rule for you to invest, that gets driven out by whatever you have experienced more. We suffer greatly from recency bias. Yeah. So we know that Nvidia has been going up by 4,000% or whatever it's been doing over the last 10 years. So we really want to buy Nvidia because that is the great stock. That is just recency bias. We are now just basing our decisions based on what we've experienced over the recent past.
Viv, is that a better way to invest? Does it lead to better returns? I imagine it may depend on sector. There may be instances where systematic funds do better. It certainly does seem to be growing from the numbers I've seen.
Yes, but people have these flaws in their logic. How do you know that's true? Casinos exist. People go to the casino and they know it's loss making logically, but they still put the money down the thing and they think this time it's going to be red because last time it was black. And that is the flaw in human cognition, effectively. I do think that there is a place for this. The question does arise that eventually, if you have everybody playing with the same advantage, if everybody upgrades to the AI system, it's like everybody getting faster engines in Formula One. It kind of negates each other. And remember, trading or investing to a certain extent is a adversarial game. Someone has to sell for you to buy, and someone has to buy for you to sell. And I mean, if they both are working with the same systems, eventually it'll come to a point where everybody has to use the most effective system. Otherwise, they'll be left behind.
So, I mean, in the end, it becomes a war between programmers, and it just and that's all. It doesn't become much more than that.
Oh yes, most certainly. We are going to be outcompeted from this. The example I use, which is well known, is the chess world. Garry Kasparov was beaten by Deep Blue in the 1990s. There was a brief period after that where the best chess player was a human working along with a machine. Nowadays, the best human cannot in any way improve the decision of even a machine that could run on your cell phone.
Okay. Chess has a certain number of variables, and Stefan, the real world has an infinite number of variables. I accept that a computer can manage more variables than I can. I accept that many humans can manage more variables than I can. But does that mean that they're always going to be right? Because they can sometimes and often be asked the wrong question in a way in which a human investor would spot that this is a problem.
Yeah, I think we overestimate that ability of ourselves, personally. So I think we really like that narrative that we can spot the turning point, or we can spot the rally or something like that. So I'm skeptical on whether humans can actually see it better. But I think where systems, I mean, if you statistically look at how do you measure investment success? I mean, the stats are quite scary. So let's assume there's a fund generating an alpha of 2% per annum. How long do you need that fund to run to know that it was all based on skill and not based on luck? You actually, statistically speaking, to be 95% confident, you need 60 years worth of track record. So the problem is, I'm not saying that there aren't people that's highly successful in investment and have great investment skill. It's just that you have to identify them beforehand. So the nice thing with systematic investment is that you have a process, and you give the machine and you tell the machine, you have a 1 month, 3 month, 1 year, 1 minute, 10 minutes, whatever your holding period. And you measure it every single time. Were you right or were you wrong? And you keep on doing it. So it's going back to the investment analogy. So you can start training your model to become the house, where you take a lot of bets, but you know that the odds of you winning is 55, 58%, depending on how successful your investment is. But because you're actually taking these bets over and over and over, you are becoming the house, and you are actually learning from and improving your process. You can actually learn, because to learn from a process, you have to repeat, you have to have repeatability, and you have to have a short response. So think of a tennis shot. You can hit that shot every single time, and you can see whether it's going in. You need to get that feedback loop so that you can train yourself to actually hit a better and better shot over time. And the same is true for systematic investment, which it's difficult to get if you keep on pushing out your investment horizon. Like, ask an investment manager what's your investment horizon, and they won't actually want to give it to you, because then they will get measured.
Yeah, yes. We're talking about technology and computing power, how they're changing investment strategies. Stefan Engelbrecht is portfolio manager for Mazi NextGen at Maxi Asset, and Viv Govender is portfolio manager at Rand Swiss. It's 10 minutes to 8.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Absa is a registered FSP.
The Money Show.
Investment School.
Stefan Engelbrecht is portfolio manager for Mazi NextGen at Maxi Asset. Viv Govender is portfolio manager at Rand Swiss. 8 minutes to 8. Talking about how technology, computing power in particular, are changing the way in which investments are made, changing the discussions that are made. So Viv, if the systems work better than the humans, the role of the humans then becomes quite interesting. For a long time, you had people making decisions. They'd run a fund, they would make the investment decisions, TV series, think Billions and Axelrod, that kind of person. Now computers take over. What is the job of the human being to actually do?
Yeah, look, I think my industry, I usually can't apply it. People don't look at their own industry and apply this thing going forward. I've looked at my own industry and applied it going forward, and I don't see how it survives in the current form in the next 5 to 10 years. You are going to have, sort of financial planners. You'll have your own LLM or like AI working on your behalf, knowing your particular situation and advising you on what to buy and what to sell in your own, portfolio, your overall portfolio. I don't see how that doesn't occur in the next, say, 5 to 10 years. It's going to be a given. And the role humans play, people used to think that humans are going to play the human touch role, the bedside manner role. And it turns out that actually these things do bedside manner and human touch better than humans do.
No, man, come.
It has been shown with doctors that basically the decisions made are roughly the same, but humans rate the AI's bedside manner, the care, etc., significantly higher than they do for humans. Why? The human is a professional that has to basically turn their money, time into money. They have a limited amount of time. The AI has unlimited time for you to ask any question, to do any kind of deep dive you want. And that is something I think that is going to be a very important thing going forward. And what's going to happen is, and this is my assumption, that in about 5 years' time or so, or within the next 5 to 10 years, you're going to have a personalized AI that you talk to more than you talk to any other person in your life. It knows you better.
It's going to be like your phone is now. You spend more time with your phone than anyone.
Yeah, but
it doesn't predict what you're going to do, but close sometimes.
But you'll develop a relationship because humans are very prone to that. You'll talk to your car. People talk to their, people talk to their, whatever it is that, and you will talk to your AI, and it'll talk back to you, and you'll develop a relationship with it, and you'll develop a trust with it, and that trust and relationship will translate into you outsourcing a lot of your investment decisions to that, as opposed to, a professional in the markets.
Okay, so Stefan, at the moment, as I think you'll know, I do business bulletins in the afternoon. Are we going to see a situation where you have a human reporting on the radio, for as long as radio and humans are around, actually on the decisions made by machines rather than on the decisions made by human beings? What I'm really asking you is, are we going to see markets actually being completely dominated by this? I realize it's been growing very quickly, and as Viv presents a very compelling case. And that would mean then that actually all we're doing is watching the results of models rather than the results of human decisions.
Yeah, I can definitely see a future where that is going to be the case. But I can also see a future where the models are just there to do the maths that we can't do. So we are still our roles are changing. So where we really want us to be the Springboks on this field, kicking the goal, scoring the try, we are starting to become more and more the Rassie, and the models are going to become the players. And we are more the person in the background, thinking of the strategy. How are the models going to react? Because to say that there will just be one consciousness of how models, or one way that models will actually get to an answer, I don't think that's going to happen, because your fingerprints, when you start programming these models, are all over the model.
Yeah.
It depends on
you could see Stefan's, and you could see Stephen's, and
Absolutely.
You could see Viv's models.
Your model will be different to my model, will be different to Viv's, because we find different things are more important to us, and we will provide more data to focus on our biases. So there will be biases built in. Our biases will be more efficiently implemented, but it will still be there. It will still be Stephen's fund. It will still be Stephen's way of investing. The actual implementation of it just will be done more accurately and more like Stephen should have done it right from the beginning.
Yeah, if Stephen stayed true. Okay, Viv, this is going to be a strange history and science fiction question in one. You made such an interesting point a few moments ago about how the Netherlands became the dominant European power and then colonial power because stock markets were invented there, and that's true. And that's a comment about the importance of the efficiency of the allocation of capital. If you put your money in the right place, you will then get a lot from it. We've been talking ahead of the G20 about putting money into infrastructure in Africa, for example. At the moment, what stock markets are really about is the allocation of capital by human beings. And and what really drives most of the human beings when they allocate that capital is where are they going to get the most return. So they're going to get a profit motive. If this all changes in the way that you suggest it will, yes, humans will play a role in a certain way. But it also may well suggest that actually there are better ways using this computing power to allocate capital that will not necessarily be stock markets as we know them. I realize that's a strange question, but it may not be in terms of shares that we have now.
Look, I mean, that's already happening. I mean, this is not even an AI situation. Anyone that looks at the current situation in the financial market has noticed that over the last, several years, companies are not IPOing anymore. And you are having more and more value being created in the private market than was ever created, than has been created in the public market. You look at when Amazon listed, when Google listed, compare it to what the valuation of SpaceX is right now, or OpenAI. They're vastly larger. OpenAI is a $500 billion company, probably worth more, in fact, at the moment. SpaceX is hundreds of billions of dollars. It dominates the space industry, and normally you would have expected by now these companies would have listed and you'd have access to it. But I think we are in multiple trends are coordinating together, and we are going to be seeing a very different way going forward. That being said, I mean, in private equity, the track record of most investors in private equity isn't great. And it's not that hard for, I think, a more systematic approach to beat that, I think, going forward.
I've really enjoyed this conversation, gentlemen. Thank you. It's blown my mind a little bit, as I think you can probably tell. I found that really very interesting. It'll be available as a podcast in a moment when Peter, who is a human, has actually put it all together for you. Stefan Ehlbrecht, Portfolio Manager for Mazi NextGen at Maxi Asset, and Viv Govender, Portfolio Manager at Rand Swiss. Thank you very much indeed.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Absa is a registered FSP.
Well, in the US, it would seem the ghost in the machine, which I suppose is another word for a human being, have pushed the Dow Jones down 0.57%. The Nasdaq is down 1.1%, and the S&P 500 is down 0.8% right now. Nvidia had strong results yesterday. Doesn't seem to be enough to keep those markets going for the moment. We'll have more for you ahead of the G20 tomorrow. I think lots of developments between Pretoria and Washington overnight. I wouldn't be surprised. Back tomorrow. Good evening. It's